All right. Hello, everybody. I am very excited to be talking to you today about VC 101, going through what is venture capital. So I'm going to try and share my screen right now. Let's see, I have to enable that. Boom. And then I'll do a presentation and hopefully everyone will be able to see it. Let me try that again. Boom, boom. All right. Is everyone able to see my screen? Niels, can you give a thumbs up if it's looking good? Excellent. All right. So what is venture capital? I'm going to take you through a really basic view of what venture capital is, but we're going to go deeper and deeper and deeper. It should last about half an hour. And again, we'll do your questions at the end. Put them into the Q&A and we'll do our best to answer them. What is venture capital is a part of the VC 101 series, which is part of Venture Institute. Venture Institute is a 100% free training program to help people get into venture capital. And why we did it is we saw these programs like VC Unlock, Kaufman Fellows, Columbia School, Harvard, whatever, and they're charging tens of thousands of dollars to learn basics of venture capital. And what that means is that it's not opening up venture capital to anyone, because if you can afford tens of thousands of dollars to go take one of the courses about venture capital, then you're not broadening the venture capital market, because those are the people that are in venture capital today, the people that can afford tens of thousands of dollars to be there. So we said, that's wrong. We're going to do something completely free. And this is a free event. The program is free. Everything we do to help inspire people is free. So let's get started on what is venture capital. So venture capital is a form of private equity. I just plugged in a mouse. Let's see. And it provides high risk growth capital to startups. Okay. That's what it does. High risk growth capital to startups. Now, we have people who apply to VC Lab and they're doing like debt, like low risk debt products, and they're trying to pitch it like a venture capital firm, or factoring, which is also kind of a form of debt where you finance receivables, or you take a percentage of revenues. That is not high risk, everybody. So while you may want to call it venture capital, if it's not high risk, it's pretty much not venture capital. So it's high risk growth capital for startups. So a lot of things get lumped into venture capital that are not venture capital. Sometimes people look at venture debt as venture capital. Venture debt's not venture capital either. Venture capital is high risk growth capital startups, and it usually involves equity, but not always. And we'll talk a little bit about that later. And what do we mean by high risk? Well, 7 out of 10 investments that a venture capitalist does will fail. 7 out of 10 investments that a venture capitalist does will fail. In fact, sometimes more than 7. And now failure can come in many ways, like the company can go bankrupt. Failure for a venture capitalist is if the business does never exit. So it could actually become what is referred to in the venture capital field as a lifestyle business, which means it's maybe even profitable, but because it has no exit, it's not, that's a failure from the view of a venture capitalist, because they have to get these exits in usually 10, 11, or 12 years. So if you have a great business and it's 12 years old and you have no intention to sell or go public, you fall in the failure bucket for a venture capitalist. So again, 7 or more of the businesses they invest in out of 10 fail, and that's what high risk is. But look, there's a lot of reward. Now, I did a way oversimplified math equation for you here, but if you took $100,000 and you put it in at a $5 million valuation, and all of a sudden that company was like a ChatGPT style success story, and it suddenly was worth $5 billion. And this does happen. This is rare, That's why they're called unicorns, because they're rare. They're a mythical creature that, you don't see many of, right? So they're rare, but you would then have $100 million. So you can take it is an asset class where people today take $100,000 and turn it into $100 million. That happens. It doesn't happen very often, but it definitely happens. And so, if you can do that, 7 out of 10 things that you invest in can fail, because that's a pretty remarkable return. And really, venture capitalists are not investing their own money. They're investing what's called OPM, other people's money. And specifically, they're investing what are called limited partners money. And there's tons of different limited partners, but I'm not going to talk about them right now, because this is really what is venture capital. So limited partners make investments into the venture capitalists. The venture capitalists make investments into the startups. They then help the startups to grow, and then hopefully the startup exits, and then hopefully they can get 1,000x and turn that 100,000 into 100 million, right? Because that does happen. They're even, just as one more aside on that, one of the best known returning funds. They're funds that return better, but they're super secret. Most VCs that are very good don't want anyone talking about their numbers, because they don't want to let anyone in on the big secret. But one of the most well-known funds returned 281x, and that was lowercase capital. So, okay, they take the LP money into the VC, they invested in startups, they help the startups, and then hopefully the startup exits. That's how VC works, super oversimplified. And the VCs make money by fees, right? Management fees and carried interest, which is a share in the upside. And so how that works is, let's say you have $100 million fund, and you have what's called a 2 and 20. That means a 2% management fee and 20% carried interest. But in fact, the 2% is calculated per year. So they get, for example, on a $100 million fund, 2% per year is 2 million per year. Funds are almost always 10 years. So weirdly, even though it's called a 2 and 20, it's really like a 20 and 20, because you take 20% of the fund for management fees and you take 20% of the upside. But venture capitalists like playing with numbers and making them sound better, so they call it 2 and 20. Now, the 2% management fees gives you about $2 million a year to run with and operate everything on a $100 million fund. Now, you have things that are called fund expenses as well. You can look that up on govclab.com, what that means. But those are expenses on top of the 2%. But, a $100 million fund, 2%, $2 million a year, that's not a lot of money, right? If you have a nice office, a few people working for you, that money goes pretty quickly. And people that work in venture capital get paid pretty well. So as you can see, there's not a lot of money in the management fees, but the carried interest is very interesting, because let's say you have a 3x or a 3 TVPI as the term for 3x in the industry, but we can just say 3x. So now the fund returns 300 million, right? So you have $100 million funds. After 10 years, you return 300 million. Well, 200 of the 300 million are in carry, because they're above the 100 million that you must return to investors first. So then you take 20% of that, and that's $40 million. And now if you average that, so that's a total of $60 million between the fees and the carry. And if you average that per year, it's about $6 million a year. So that's starting to get a little bit better. But again, not groundbreaking. For really the VCs to do very, very well, they need to get those 10x or better funds, and which happens pretty commonly as well. But a lot are 3x too, and that's what the budget would look like. And I'm oversimplifying here, everybody. There's a lot more nuance to this, but it's directionally accurate. and we'll do more advanced sessions to go into greater detail on all this stuff later. All right. So as a result of all this, VC firms are small, right? They'll have one or two managing partners that run the whole thing. They may have some general partners that are primarily there for investing. They'll have some venture partners that, entrepreneurs in residence, EIR, stuff like that. They're kind of like networking people that they have involved in the firm. They may have a principal, an associate, and an intern, right? Something like that. So the only time you see these really big venture organizations are like the Andreessen Horowitz or whatever, and they have billions of dollars under management, so they can afford to have engineers and non-operating partners and all this. But most VC funds are kind of small mom and pop shops. They look like mini consulting businesses, one or two managing partners, one or two general partners, one or two venture partners, one or two principals. It's kind of, but they have a pretty big impact, right? And I'll talk about that in a minute. And so the average venture capitalist or someone working in a venture capital firm in a day will, on one hand, be talking with their limited partners, right? Either new limited partners or limited partners that they want to get more money from for a new fund or whatever. So they're talking with limited partners. They got a network in order to find the deals that they invest in. They're meeting with founders that they're thinking of investing in. They conduct due diligence on founders that they're further along in the process with, and I'll talk about that in a moment. And then they're trying to help portfolio companies, right? Because you may be on the board of a portfolio company, or you may want to, this portfolio company is doing really well. They have some exit interest. You want to help them exit so that you can get money back to your LPs, right? It's a pretty
You're breaking up a bit there.
Busy lifestyle. Now I see someone raise their hand. Just a reminder, everybody, happens in the Q&A. We're only in the startup ecosystem. Companies that change the future. Niels, you unmuted. Do you have something you want to add?
Yeah, you were breaking up for a bit during the last.
Oh, if I break up, just say something. I'm traveling, everybody. So I was on a plane ride and I got off the plane ride. I got to the hotel and I'm here for you. So if I break up, say something, Niels, and I'll take a little moment to let it work better. So VCs fund companies that change the world. Okay. That's what they do, right? Because they're taking some if you fund a mining company with venture capital, it's not going to have an impact because mining's well understood. It's an industry without a lot of growth. So venture capitalists have to fund batshit crazy ideas that have a chance of working, because that's how they get the 1000x. They don't get the 1000x backing real estate and traditional industries. They have to back crazy things that are going to change the world. And therefore, venture capitalists aren't known for being seminal in changing the world because of that. And so the role of a venture capitalist is in many ways a steward of limited partner money, right? They're looking after limited partner money. They're a steward of the success, the companies that they invest in, because they want to try and help them to be successful. And, the good ones also and they're a steward of the future of humanity because they're investing in things that matter. So in many ways, the role of a VC is a steward or stewardship. And they're professional investors, right? And this is very important because if you're an angel investor, you invest in whatever you want. You can be like, I feel like pink flowers today. I want to invest in a pink flower flower company. You would never invest in a pink flower company as a VC, right? Because it needs to have the ability to have 1,000x. And if the company doesn't have the ability to have 1,000x, or it's like such a straight, like, so it's not even in the likelihood realm of possibility, it would be an extreme outlier. A VC really shouldn't and couldn't invest in it. And they have to be professional in how they do this. And I'll talk, it's a professional investor class that's really looking for those outsized returns. All right. And one of the ways that they're able to deliver the outsized returns is through value add. So it's very difficult to become a venture capitalist unless you've either been a venture capitalist before, or you have some deep domain expertise that you're bringing to the table because of value add. You won't be able to add value unless you have this experience. So firms tend to fall into one of two buckets. They're generalists or specialists. So like a Sequoia is a generalist, and Andreessen is a generalist. They do some crypto, they do some blockchain, they do some SaaS, they do some hardware. They kind of do a spattering of everything. And then specialists really focus, right? They focus on
You're breaking up again, Adele.
So a traditional thesis for a venture capital firm, whether they, to back, general tech companies based on their history of that were seminal to the internet, something like that. That's their secret sauce. How's my internet holding up, Niels? I saw a warning there.
Yeah, it was a bit spotty the last minute or so. It's better now.
Good, Niels?
Yep.
All right, good. Yeah, you unmute. You don't even need to say anything. Just unmute and I'll know that it's spotty, and I'll slow down a bit. So this is a thesis format that we've created at VC Lab. It's used by most new managers in the world today, and many established managers. And it just gives you a sense of how funds focus. So they pick a size of the fund, they pick a stage that they're going to invest, and they add state. There's some way they're unique in that. Okay. Now, in general, VCs have some good things about them and some bad things about them. On the good side, they're professional. They generally invest with conviction. They're like, I really believe in this company. I want to back it. They add value and they take big risks. On the downside, let me see if I have a little water here, guys. On the downside, my water, they're usually operating alone, right? Even if you're in a partnership with 2 or 3 other people, you're operating alone. You want to be the one that brings in the deal. You want to be the one that's on the board of the company. And you don't really want like your partners share in your kind of victory. You want it to be yours, right? So even partnerships, VCs tend to operate like lone wolves. Not always, but most of the time. And as a result, there's a lot of sharp elbows. It's like, it's my deal if I'll let you in, right? So what happens a lot of the time is one partner at a firm gets in the hot deal and they'll make some allocations for their friends and they'll cut other people out of the deal that they don't like. And so it can be a very sharp elbow business. And it can be predatory because a lot of the VCs, when they see a deal, they might convince the founder to give them, unfavorably good terms and things like that. So it's a commonly predatory business. And you've probably heard stories, but they can abuse power, right? Now, we're changing that. At VC Lab, everyone we work with agrees to the Mensorious Oath, which is an oath of ethical conduct and ethical investing. And if we feel that someone's not following the oath, we remove them from the community. And everyone we let in the Venture Institute is going to have to agree to the oath as well, because we don't want the bad. We want the good and not the bad. And ethics are a large part of why the bad is there, right? So how do investments work? So we talked a little bit, what is venture capitalist, sort of what does that role entail? Now I'll talk a little bit how investments work, and then we'll wrap it up with how to actually do an actual investment and take your questions. So doing good on time. There are two stages of investment, early stage and late stage. So in the early stage, there are about four. Some people today consider Series A in the late stage, FY. And there may be another earlier stage one here called friends and family round. So you could very well move Series A into later stage. But the interesting thing is all seed, pre-seed, and angel people kind of call Series A these days sort of later stage. It's like a tween stage. And all Series A investors call themselves early stage. And the reason for that is that the money is made in early stage, okay? You can make the 1000x in the early stage. You can't make 1000x in the later stage. And this is an adage of venture capital that you need to understand. Smaller funds almost inevitably do better than bigger funds because it's easy to take a $100 million fund and to turn it into $1 billion, but it's very hard to turn a $1 billion fund into $10 billion, right? Just because, let's say you have $1 billion fund. All right, well, it doesn't make sense for you to make investments of under 100 million. It probably, because maybe a few, right? You need usually your portfolios, maybe 10 companies, sometimes 20. So let's say you made it 20 companies and you went for like 50 million each. You just got to get these big outcomes on a $50 million investment, which doesn't really happen in the real world. Practically speaking, you see those big 1000x outcomes when you get in at a $5 million valuation and the thing goes to a $5 billion valuation. By the time you're putting in 50 million or more, the valuations are usually in the hundreds or millions or billions. So then it's got to go from like a $5 billion company to like a $1 trillion company or something like that to get the kind of returns. So it just doesn't really happen. All right. So let's go through what the stages are. There's an angel stage, a pre-seed stage, a seed stage, and a Series A stage. The investment amounts are different and the level of traction of the company are different. So you could, at the angel stage, you have an idea. At the pre-seed stage, you usually have a prototype. At the seed stage, you're starting to get customer traction. And at Series A, you've got sort of product market fit and you're looking for a little bit of growth. And that's sort of how those stages work. And then you're going to move into later stage funding. And for here, I put Series B, Series C, mezzanine. Now, at these levels, by the time at Series B, you're really like, all right, I've got everything figured out. I've got my growth model figured out. And I just need I need to put engine into the fuel into the engine, right? Because the engine's running great. More fuel, faster growth, right? And so usually use it to expand your growth quite a bit because you know how your growth works really well. And then by the time you're going for Series C, you're like, all right, we got the growth. All this is working. Everything's dialed in. I want to launch a new product line, open offices overseas, whatever else. And you're going to lay in some infrastructure. That could be Series C, Series D. And then eventually you're going to do a mezzanine round, which is money before you go public. So basically you say, look, I'm planning to go public. All my stuff is dialed in. Everything's running really well. I'm going to take in some capital to prep myself to go public, scrub the books, add some extra headcount in investor relations, all this stuff. And so that's usually what the mezzanine rounds are for. And I'll take you through a little bit of how a deal gets done by a venture capitalist. Most people on this call are going to be looking at the early stage of venture capital, because by the time you get into the later stage, it really is more like what's called private equity than venture capital, though a lot of venture capital is performing so well that everyone and their mom wants to be a venture capitalist, including private equity people. Like if you're in private equity, like why wouldn't you want to call yourself a venture capitalist? Because they make more money, it's better returns, they have a better brand. Private equity is like kind of boring, field. But to be fair, the later stage venture capitalists, they're really like private equity. They're not like venture capital. If they may be in a gray area, but they're definitely dark gray, right? So let's talk about how deals get done. And this is kind of how deals get done at every stage. But it's leaning towards early stage. So believe that I'm probably oversimplifying, right? So I'll take you through sort of did you unmute? Was I breaking up there a little? Okay. So there are three parts of the process. Sourcing, right? Which is finding the deals. And I'll go through that first. So, and these are each of the steps in the 14-step process. So you're going to need a network, right? Venture capital is a networking business. Then from that network, you're going to have to filter through and find the companies that are most interesting. So you're out at events, you're out, and then you're getting in business cards, getting in business plans, meeting people, connectors, all this stuff. And then you're going to have deals. That's your sourcing, right? And you're going to have to look at the deals. And then there'll be ones that you are like, this is pretty interesting. So then you're going to want to meet with them, right? The founders could be over Zoom. A lot of times it's in person. And if you like that, if you like the meeting, you're going to do some due diligence, right? And usually the first steps of due diligence don't really involve the company. The venture capitalists can do the due diligence on their own. So they don't need to have the founder or CEO involved. They can just research online, talk to other people, et cetera, et cetera. If it's interesting. If they are interested in the deal, there's a negotiation phase, and this will involve usually 5 steps. So it's like start the negotiation. The early stage, it says my network. The company creates the terms and gives it to the venture capitalist, and the venture capitalist then may push back, and that's how negotiation will happen in the earlier stages. And while that negotiation's ongoing, the venture capitalist will need now to do some detailed due diligence. And the whole FTX debacle, that cryptocurrency that collapsed, was a failure of venture capital due diligence, because Sam would walk in and be like, I got 20 VCs interested. You got 10 days and I'm giving you only this material. And so they were like, running around, and they just didn't do good due diligence, and they funded a fraudster, right? So you have to get your due diligence done as a VC, or you look like an idiot, right? And then oftentimes you're going to have either an investment committee or a partner meeting, and you're going to need approval from the firm to make the investment, at which point you often have to do some legal work, right? And then once that's all done, you need to sign and send the investment, right? So it's not like, oh, I'm just going to invest, boom, done. There's like a 5-step process. As I said, this is oversimplified. The overall, it's like 14 steps to do a deal. And we're at roughly 9 right now. And guess what? There's or 10, there's 4 more, which is support, because just what you put the check in the deal is not the end of your investment, right? For angels and for a lot of friends and family, it's the end. But for venture capitalists as professional investors, the check is the beginning. The exit is the end. So you've got to assist the startup. You've got to get updates from the startup. You've got to help them to get liquidity. And if they have exit opportunities or they want to go public, you've got to be there, because the people that get screwed on the cap table are the people that aren't present. The angels that haven't been around in 5 years, they get screwed. The employees that quit 5 years ago, they get screwed. But the venture capitalist that's standing there every day trying to help you, they get paid out, usually first, right? So when that liquidity event is coming, you got to be front and center. And then when you get that distribution to you, because the company exited, you've got to distribute it out to everybody else, right? So it's an awesome job being a venture capitalist. You get to change the world, but it's quite a bit harder than it seems on the surface. And I hope I gave everyone a pretty good sense of that in this overview. So I want to turn it over to questions right now. Do you want to read the questions, Niels, and by the most upvotes? Now, in the questions area, there's a thumbs up. If you like a question, click the thumbs up. We'll spend the next roughly half hour and answer everyone's question that we can.
Okay, shall we get started, Liam?
Yeah, let's get started.
Our first question is actually about something you were just talking about, liquidity.
Actually, you know what? Let me get a little water.
Yep.
Hold on a sec, and then we'll get
Also
started.
liquidity.
All right, now we'll get started.
Okay.
Hey, everybody.
Speaking of liquidity, Annie is asking, is exit the only option for startups if they go for VC funding?
Yes, that's it. So Sequoia is setting up what's called an evergreen fund to put their fast growing startups that don't want to go public or don't want to exit into a vehicle so they don't have to sell the positions or whatever. But basically, every startup that a venture capital firm invests in must achieve an exit. Now, there's a 10-year and usually with up to 2 years of extensions for a VC firm. So you have 12 years to get there. Now, if you don't get there, what you can do is distribute the shares. And I know someone who was in Ron Conway's first fund, and he got shares of Google because Google didn't go public in time, and he still has those shares. And I think they were like, I don't know, $2 a share, and the stock split a zillion times. So it's like they're probably worth crazy amounts of money today. But he still has shares from Ron Conway's very, very early investments in the beginning of Google, because Google didn't exit in the 12-year timetable. They decided, okay, we'll just distribute the shares to the investors. So yeah, I mean, it's an exit is the goal.
Yeah, I think this also ties into a question Kirill asks, if a fund's length is 10 years and it invests in a company on the 9th year, should it last more than 10 years?
No. So you have, that's a good question. So the way funds work is you have what's called an active investment period. That's usually 2 to 4 years. Most are 3 years. So funds don't really do new investments after the second, third, or fourth year, depending on what their active investment period is. So no one will invest in the ninth year in a new deal. The latest that ever happens is usually the third or fourth year, depending if you have a longer active investment period. But some only have 2 years, and that would be a shorter active investment period.
Another question about Kirill about structuring things. If a year's management fee is not spent fully, what happens to it?
Well, it's just owed. Yeah, a lot of managers don't take their management fees. So because they want to use that money to invest. And the management fees, you don't go through a waterfall. So they're not usually 2% every year. Might be 3.5% year one, 3.5% year two, and then they tail off over time. But they sum up to 20% for the whole life of the fund. And so they're just like an accrued liability to the manager. So if a manager doesn't take and aligned by the LPA, but generally speaking, if a manager does not take the management fees, it's a liability to the manager that can come out of future proceeds.
Patrick is asking about if you are setting up your first fund as a solo GP, what's the ideal fund size to aim for when you're investing in pre-seed?
It depends on the region, but no one, like, guys, don't, everyone's like $50 million. I'll tell you, it's $5 to $10 million. You should not have a fund size greater than $5 to $10 million as a new manager. If you really know a vast number of rich people, like endless numbers of rich people, you can go to like 20 million. But unless you're able to say, hey, I can make 10 calls this afternoon and have 5 million in the bank and mean it, then your fund size should be $5 to $10 million, especially for a new manager. And if you're in the developing world, it should be more like 5. If you're in the developed world, it probably should also be 5, but it shouldn't be more than 10.
Speaking of new managers, Michael is asking, what do you see as the biggest bargaining chip for new managers that are trying to raise their first fund?
All right, everyone, use your thumbs to upvote because we got lots of questions here. I want to get through the most upvoted ones. There's no, look, if you're talking about with LPs, there are no bargaining chips. You should not, you shouldn't take no fees. You're gonna die? Like you have to earn fees as a manager. So look, there's no bargaining chips, right? You're not negotiating with LPs. You're like, I'm going to invest your money into this area and I'm going to get outsized returns. Okay. That's your pitch. And if they're like, well, I don't want to pay you fees, well, then like, that's insanity, right? Like, I'm not saying the venture capital fee model is the best model ever. It definitely has flaws, but in funds 100 million or less, the 2 and 20 model, as I just showed you, isn't that crazy? Getting paid $6 million a year to make expert investments in complicated companies that require extensive due diligence and providing support. That's not a really big budget, right? And that a lot of that 6 million, 4 of the 6 million per year is really based on your success and comes much later. So back to the point, you should never negotiate on fees as a new manager. It's just terrible precedent, right? I'm not going to get paid for the hard work that I have to do to set up this fund, et cetera. Just never do it. Very, very bad idea. I realize I haven't stopped sharing my screen. So I'll do that right now. Let's keep with the questions though.
Okay. Do you see managers actively shifting their investment strategy towards an ESG focused portfolio?
Yeah, not really. No, so about 29% of the funds that we work with have some sort of impact lean in their thesis. But I don't know if that's like a shift. It's been, we have to, guys, like, we can't, we have to invest in things that are going to fix the world. This world is a giant trash bin. We make things that don't last, that we throw away and pollute the planet on a constant basis. Our food waste is enormous. Our clothing industry is highly destructive. Our everything we do is just bad for the planet. We kill like endless amounts of animals every single day to feed people that don't need to eat animals every single day. We cut down most of the planet's forests and wild areas to grow soybeans to feed these animals so that they taste better to us, but they make the animals incredibly unhealthy. I mean, we're living in a demented, unsustainable, and frankly, destructive way that needs to change, right? And so venture capital is going to change it for sure. It's not corporations. It's not the government. It's not, I can't really think of anyone else that can have a bigger impact, right? Because, I could take $10 million, and if I'm a talented, smart person, I could fund 20 companies. And let's say you get 6 successes out of that, right? Because 7 out of 10 fail. So 20 companies, 6 successes. But those successes, are concentrated, let's say, in food, so that now we have, sustainable packaging for food or regenerative packaging for food. We have food that isn't killing the planet. Like, so those 6 success stories in food could actually change the whole food industry, right? So we need venture capitalists today with morals working to make the world a better place, succeeding, and the companies that they're backing succeeding as well. All right, let's keep rolling.
Yeah, this actually dovetails nicely into our next question, which is from Ali, who wants to start a fund to focus on climate change with her partner in Spain. She is basically asking what's the best way to get started, and does it make sense to work at a VC firm to get experience before starting their own fund?
Look, it's very hard to start a VC fund as a young person. Let's start there. You need to have a network, and you don't get out of college with a network. You get out of college with your college buddies, but your college buddies often haven't done anything yet, and you're not like tied in with their network. So the one critical thing that you need as a VC is a network. That's number one. If you don't have a network, you can't be a VC, right? Let's start there. So that's table stakes, right? So if you don't have a network now, you got to start building your network now, right? That's number one. Then number two, you need track record. Now the track record, the problem with working at another firm is very rarely will a firm say, let me give you an example. Let's say you worked at a firm, and let's say you were responsible for 5 of their top 10 deals. And you were to go out and say, hey, I got these 5 deals for this firm, and now I'm starting my own firm. They would never allow you to say that. Never in a million years. Because you would be essentially fighting their brand in the market, taking claim for stuff you did there, but it would hurt them. So they'll just be like, no, you can't say that. And you can't say that if they say you can't. So you can't work at another firm and cherry pick their portfolio. They will stop you, and you're not really legally allowed to do that anyway. So they'll sue you and win. So, basically it's kind of the best way to get track record is to do some select angel investing with whatever money you can scrounge together and really hit some home runs. It's way better than work. So build your network, do some select angel investing, and get some home runs, and you can be a VC. And that's really the way to go.
Patrick is asking basically, what's like the main value add that new fund managers can offer their LPs?
Yeah, so we have this track record article on GoVC. Could you paste it in there, Niels? So basically just read that. That covers all the different ways you can construct your track record to look good to limited partners in your fund, Patrick. So check that out. And then I see Naneka is asking, do you happen to know what a typical TVBI for VCs that are in Africa? So look, there is data on that, mainly by PitchBook. But that data is just bullshit because look, here is what we do know, right? Venture capital is the #1 performing asset class by a large amount. The top performers crush it. They average some years a 9x. So everything is vintage year based in venture capital. And vintage year is the year that you form the entities and close on capital. So if you form your entities in 2023 and close on capital in 2023, you will be vintage 2023. The vintage year of venture capitals is the #1 determinant in success, period. What happens is the top decile, top quartile, et cetera, kind of move around. They've been the #1 performing asset class for over 5 years in terms of TVPI, IRR, all that stuff. And then the vintage year is the #1 determinant. Now, within VC, right, Africa hasn't been around that long. Like one of my friends launched one of the first funds in Africa. I mean, he says it's the first, but there were others. And that wasn't that long ago. He's not like 90. It's like, so venture in Africa is basically like not even a decade old. So they're like, we don't know, right? So I would say it's too early to tell, but it's looking to be within the range of venture capital. New managers have the best TVPIs. Emerging managers are #2. Established managers are obviously #3. So that's well established. And it looks like Africa is going to be one of the most promising segments as well.
Speaking of geographies, are there any geographic restrictions for VC investment?
No, but here's the issue. LPs don't want you investing. So the venture capital structure is a pass-through structure. So technically the LPs are owning positions in these little companies all around the world. The VC doesn't own it. The fund doesn't own it. It's passed through to the LPs. That's why VCs don't invest in LLCs, because they don't want to themselves invest in pass-through vehicles. And all of a sudden they're sending like little, oh, you owe the Nigerian government money because the Nigerian company that we invested in is also a pass-through company, and they had some profits and they passed the taxes along to us and we passed it along to you because you're an LP. So LPs just don't want any. First of all, VCs don't invest in pass-through entities, and LPs definitely don't want to have investments all around the world, because then they have to deal with the tax and regulatory concepts of that. So what ends up happening is LPs will say, I only want you to invest in Europe, or I only want you to invest in the US, or I only want you to invest in these countries in Africa, because they just don't want to deal with all the mess of like, oh, I have 10 African countries that I have to file taxes in because we've had 10 exits this year or something like that. Like said no one ever, right? No one wants to do that. So the LPs will demand geographic focus.
Question from someone in our current cohort. If you're raising a small pre-seed micro fund, is it acceptable to invest at pre-seed and then sell your position in the next round?
No, because that's not how VC works, right? That's not a VC fund. VC fund is high risk, high reward. What you're doing there is like lower risk, lower reward. That's not venture. Like venture implies risk, right? So it's like, I have an idea. I want to take like a penny and sell it for 5 cents, right? And that you can make lots of money doing that, right? You can make lots of money taking something that costs 1 cent and selling it for 5 cents, but that's not venture capital. Venture capital is like investing 100 grand and walking away with 100 million, right? So can you do it? Yeah, you can do it. Is it venture capital? Not really. No, right?
Eliza from Malaysia is asking, are there any opportunities for people new to the industry to start remotely?
Well, there's no need to start remotely because venture capital is everywhere in the world right now. It's in Malaysia, it's in everywhere. By the end of 2023, I don't think there'll be a country left in the planet, with some exceptions like North Korea, possibly Iran, but probably not, because there's an entrepreneurial movement there. But like, it's really kind of the like derelict countries on the planet. But I think most, if not all, countries will have some venture capital activity, possibly even North Korea. So you don't need to go anywhere else. Remember, upvote questions. Upvote questions. We got 5 minutes left. So let's move a little
we have
faster.
a hard stop.
Yeah.
So another geography-based question. Patrick is asking, what other geographies are basically the most promising?
Look, anywhere, look, every country has massive amounts of disruption happening. So there's incumbents that need to be disrupted in every country around the world, from Indonesia, Malaysia, I mean, Central Asia, like Mongolia, etc., all across Africa, South America, etc. So there's 10x opportunities everywhere in the world, and we're seeing 10x opportunities. In fact, we're seeing 100 and 1000x opportunities everywhere in the world.
Femi is asking, are there any qualifying exams needed to get into VC?
No, I mean, no. So there's certain activities that VCs may engage in that might require you to get a broker-dealer license. So that's a very, it's the reason I hesitated is it's a very tricky question to answer with just a yes or no. So there's certain activities everywhere in the world that require licensing to do as a VC, but not all VCs do them. So not all VCs get licenses. And then there's some places in the world like Singapore where you actually also have to get a license to be a VC. But generally speaking, in the US, EU, etc., you don't necessarily need a license to be a VC. There are some activities you might want to do as a VC that you need a license for that are optional. Is the kind of easiest, fastest way to answer that.
Okay, this may be the final question or second to last question. Patrick is basically asking, are fund of funds a good idea to approach for new managers?
No, so the fund of funds don't invest in new managers. I can count on one hand the number of fund of funds that actually invest in new managers. A lot of them will say they invest in new managers. They'll be like, we totally invest in new managers. But when you actually look at it, they don't invest in new managers. But back to the point. So I would say that's probably your worst target. Look, we'll go through targeting and other things on the types of LPs for types of funds, etc., in the Venture Institute. That's starting in July. but we've had so much demand, and we had about 1,000 people apply in 10 days that, and we want to try and let everyone in, but not when we have 1,000 people apply. So we're going to, I mean, we could just shut admissions right now. I could flip a coin on that, but we did agree to Sunday. So we're going to give everyone that is interested in more of the learning side of venture capital, learn how it works, all this stuff. It's totally free, but we already have way too many applicants. So you have to get your full application in by Friday. You can just go to govclab.com. It will say right on the homepage, there's 2 buttons: apply to Cohort 12, apply to the Venture Institute. Go to the Venture Institute one. We'll explain the program. You can apply right there. It's sort of a nights and weekends, about 10 to 20 hours a week. I'd say probably 15 hours a week for most people. 2 months long, you'll learn everything. And then another 2 months, you'll actually do a field work with a VC to take all that knowledge that you've gained and actually apply it. And that will hopefully get you a job in the field as well. All right, everybody, this was awesome. Thank you, Niels, for your help. Sorry the internet was choppy. I just got off a plane, ran in the room, got right here, and hopefully it was smoothly, despite some hiccups in the internet. Thank you, everyone.
Bye.